In today's video, we're going over the different retirement accounts. There may be more options out there than you realize. Let's take a quick look at each of them to determine which one may be best for you. It's coming up next. Hey, this is Mel Stubbs. I'm a financial planner here at Christy Capital Management, and we aim to bring you good content and bring clarity to you in the midst of confusion. Today we're going over the 6 different types of retirement accounts. Also, every couple of weeks we send out articles and videos and other resources to keep you informed to be ready for retirement. You can go to christycapital.com/email. In fact, if you do it right now, you'll get 3 videos that answer the 3 biggest questions in retirement. So here's a chart that has it all laid out for us. Let's start off with an IRA. It stands for an individual retirement account. And so by definition, this can't be a joint account with a spouse. Each spouse would have their own IRA. You put money in pre-tax and you get the tax deduction in the year of your contribution. The money grows tax deferred, and then upon withdrawal, you will be taxed on your income tax bracket level. Now there's a contribution limit of $6,000 per year, and if you're over the age of 50, you can contribute an additional $1,000. There's a 10% penalty if you withdraw the money prior to the age of 59 and a half, and there are required minimum distributions, meaning that you will have to start taking money out at age 72. There are unlimited investment options that you can pick inside of an IRA. The IRA is just the wrapper that lets everybody know that this money here has not been taxed yet. It will be taxed when you take the distribution. Now let's look at a Roth IRA. This is money that you put in after you pay taxes on it. It grows tax deferred in the account, and then you take distributions out tax-free as long as you are over the age of 59 and a half and you've had the account for 5 years. It has the same contribution limits as the traditional IRA of $6,000 per year, and if you're over the age 50, you can contribute the extra $1,000 as well as catch-up. This also is an individual account. You have an unlimited investment options to pick from. And this is also a wrapper that lets everyone know that it's a Roth IRA, so correct distributions will be tax-free. Next, we have a traditional 401k. This is set up through the company that you work for. Money gets put in here pre-tax, and you'll get a tax deduction in the year of your contribution. All distributions will be taxed at your tax bracket. You can contribute up to $19,500 per year, and if you're over the age of 50, you can contribute another $7,000 on top of that. This is probably the most common account people have who work for organizations. For federal employees, this would be your TSP account. Now, similar to this is the Roth 401k or Roth TSP. It has the same contribution limits we just talked about for the traditional 401k. The main difference is when you put the money in, you don't get the tax deduction. You don't get to write it off in the year you do the contribution. It grows tax deferred, and then if you take out the distributions after the age of 59 and a half, they will be tax-free. So what is a simple IRA and how does it work? A simple IRA is a savings incentive match plan for employees' individual retirement account. It's a retirement plan for small businesses with fewer than 100 employees. Simple IRAs are similar to other individual retirement accounts, but they're just easier to set up than 401ks. But the employee contribution limits are lower than 401ks. Small businesses sometimes offer workers a simple IRA plan in lieu of a 401k because, as the acronym implies, it is easier to set up and administer. If you work for yourself, you're also allowed to contribute to a simple IRA, although there may be a better retirement option for the self-employed. That better option may be a Sep IRA. Now, contributions to the simple IRA are less than 401k and less than the Sep IRA. You put money in the simple IRA pre-tax, which means that the withdrawals will have to be taxed, and also you have to abide by the required minimum distributions at age 72. So what is a Sep IRA? The first part stands for Simplified Employee Pension, the second for Individual Retirement Account. A Sep IRA is a basic individual retirement account, much like the traditional IRA. The Sep IRAs are for business owners, and contributions are tax deductible. Investments grow tax deferred until retirement when distributions are taxed as income. Generally, Sep IRAs are best for self-employed people or small business owners with few to no employees. And here's why. If you have employees whom the IRS considers eligible participants in your plan, you must contribute on their behalf. And those contributions must be an equal percentage of compensation to your own. Because of that rule requiring equal contributions as a percentage of compensation, a Sep IRA is generally best for self-employed people or small business owners with few or no employees. Now, one of the big benefits of the Sep IRA is that you can contribute up to $57,000 or 25% of your net earnings. This has the highest contribution limits of any of the other options. Since this is an IRA, it would have the same 59.5 rule for avoiding the 10% early withdrawal penalty, and it would also have the required minimum distribution rule at age 72. Hopefully this information has been helpful. If you need help figuring out which account is right for you, reach out to us at Christy Capital Management. Go to christycapital.com. We've helped some federal retirees who have started a new career as a self-employed person set up the correct account for them to contribute to now that they've started their second career. Knowing the right account for the right situation can make a big difference. If you're tired of doing things on your own and you want to work with someone that understands these differences and can put together a plan for you, please give us a call on the number on your screen or visit our website at christycapital.com. My name is Mel Stubbs. I'll talk to you on the next video. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally, so seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.